Retail investors are still refreshing AI charts and chasing the next chip name. Meanwhile, the real smart money has been quietly building positions somewhere far less glamorous and far more certain. While the crowd debates GPU market share, billionaire-backed funds and institutional allocators have been loading three classic defense primes. These are not speculative growth stories. They are multi-year contracted cash flow machines sitting on record backlogs in a world that is rearming at the fastest pace in decades. The divergence is becoming impossible to ignore. Geopolitics is no longer a background risk. It is a structural driver. NATO members are raising spending targets. U.S. budgets continue to prioritize munitions, missile defense, and next-generation platforms. And allies from Europe to the Indo-Pacific are placing multi-year orders. This is not a one-quarter spike. It is a multi-year rearmament cycle. Defense contractors operate on long-cycle contracts with high visibility, strong free cash flow conversion, and pricing power that pure software or AI names cannot match. While retail capital chases narrative-driven multiple expansion in technology, sophisticated capital is rotating into the physical assets and systems that actually deter conflict and equip the warfighter. The three companies below sit at the center of that shift. Their latest 2026 numbers already reflect accelerating demand, expanding backlogs, and raised guidance. Here is the real analysis, not the hype. Stock number 1, Lockheed Martin. Start with the purest large-cap defense, pure play. Lockheed Martin. In the second quarter of 2026, the company delivered sales of $20.1 billion, an 11% increase from the prior year. Net earnings reached $1.8 billion, or $7.94 per share. A dramatic improvement from the year-ago period that had been weighed down by large program charges. Cash from operations hit $2 billion and free cash flow came in at a robust $2.9 billion, swinging sharply from the prior year negative figure. The backlog climbed to a record $230 billion, an increase of roughly $64 billion year over year, driven in large part by a 7-year, $35 billion multi-year contract with the Missile Defense Agency to significantly expand production of THAAD interceptors. Management raised full-year 2026 sales guidance to a range of $79.75 to $75 billion, lifted diluted EPS guidance to $29.95 to $30.65, and projected free cash flow of $7.0 to $7.2 billion. Segment performance told the real story of demand. Missiles and Fire Control led the way with sales rising 19% to $4.1 billion on production ramps for PAC-3 THAAD and Precision Strike missile programs. Aeronautics posted sales of approximately $1 billion, up 9%, supported by higher F-35 production volume even as some delivery timing fluctuated. Rotary and Mission Systems and Space also contributed solid growth. The company has been deliberately expanding munitions capacity ahead of contracts and building allied manufacturing sites, positioning itself for the sustained restocking cycle now underway. This is exactly the profile institutional investors favor: visible multi-year revenue, improving margins on mature programs, record backlog visibility, and free cash flow generation that supports both reinvestment and shareholder returns. While retail focuses on the next AI earnings print, Lockheed is converting geopolitical urgency into contracted cash flow that stretches years into the future. Stock number 2, RTX. The transition from pure platform contractor to diversified aerospace and defense giant brings us to RTX. In the second quarter of 2026, RTX reported sales of $24.7 billion, up 14% year over year and 16% organically. Adjusted earnings per share reached $1.89, a 21% increase. Operating cash flow was $5 billion and free cash flow came in at $2.9 billion. The company backlog stood at a record $289 billion, $170 billion commercial, and $119 billion defense. Raytheon alone booked nearly $20 billion in new awards in the quarter, producing a book-to-bill ratio of 2.4 and lifting its segment backlog to $86 billion. International customers accounted for nearly half of those awards, including more than $5 billion for GEM-T Patriot effectors and substantial AMRAAM and classified contracts. Management raised full-year 2026 adjusted sales guidance to $95 to $96 billion and adjusted EPS to a range of $7.10 to $7.25, while tightening free cash flow guidance higher. All three segments, Collins Aerospace, Pratt & Whitney, and Raytheon, posted double-digit profit growth. The commercial aftermarket remains resilient, providing a valuable counterbalance, but the defense surge is the dominant 2026 story. RTX's ability to capture both the long-cycle defense restocking wave and the commercial aerospace recovery in one liquid, well-capitalized vehicle is precisely why sophisticated capital continues to accumulate shares. The combination of a massive, growing defense backlog and rising commercial demand gives the company earnings visibility and cash flow durability that few pure-play AI names can currently match. Stock number 3, Northrop Grumman. Completing the trio is Northrop Grumman, the stealth, space, and autonomous systems specialist. In the second quarter of 2026, the company reported sales of $10.9 billion, up 5% year-over-year and 10% sequentially. Net earnings were $1.09 billion, or $7.68 per diluted share. Operating income reached $1.1 billion with a 10.1% margin. Net awards totaled $20 billion, producing a strong book-to-bill of 1.84 times and driving the backlog to a new company record of $105 billion, up 17% year-over-year. Management raised its full-year 2026 sales and adjusted profit outlook on the back of this momentum. The strategic story remains centered on high-priority national programs. The B-21 Raider stealth bomber continues to advance, with the Air Force and Northrop reaching an agreement to expand production capacity by 25% using $4.5 billion in already authorized funding. This acceleration compresses delivery timelines while the company itself is committing significant capital, hundreds of millions in 2026 and multi-billion dollars over the following years, to facilities and manufacturing infrastructure. Sentinel ICBM modernization, Triton unmanned surveillance systems, and tactical missiles further reinforce the long-duration backlog. Northrop's portfolio is more pure defense than many peers, with limited commercial aviation exposure, which means its revenue is tightly linked to the same rearmament cycle driving Lockheed and RTX. Classified and high-priority programs provide multi-decade visibility that is difficult for any AI hardware name to replicate. Institutional allocators value this combination of strategic importance, record backlog depth, and relative insulation from consumer or tech cyclicality. Retail capital is still chasing the loudest AI narrative of the moment. Meanwhile, the quieter money has been building positions in Lockheed Martin, RTX, and Northrop Grumman, three companies converting rising global defense budgets into record backlogs, rising free cash flow, and raised 2026 guidance. These are not momentum trades. They are multi-year contracted businesses with structural demand, high barriers to entry, and cash generation profiles that reward patience. Geopolitical risk is not fading. It is being priced into procurement plans across NATO and allied nations. The latest quarterly numbers already show the acceleration. Do your own due diligence, size positions according to your risk tolerance, and remember that the most durable compounding often happens in the industries the crowd is currently ignoring. While others debate the next chip cycle, these three defense primes are already booking the next decade of demand.